While national headlines scream about an office real estate apocalypse, the Coeur d'Alene office market just saw its vacancy rate drop to an astonishing 4.0% in Q2 2026.
Well, yeah, that's wild.
Welcome to the deep dive. Today, we are looking squarely at the Q2 2026 Activate Real Estate Market Report for the Coeur d'Alene, or CDA, office sector. And honestly, the data we're parsing today completely defies that whole death of the office narrative you see on the news every night.
Oh, absolutely. It's practically the opposite story here.
Right. So all figures cited today are directly from that Q2 report. And we promise that in under 20 minutes, you will be fully briefed on the underlying mechanics of what is actually moving this local market.
And it really is a fascinating market to look at right now.
For sure. Real quick, as always, if you want a custom market breakdown for your own properties, or, if you just have specific questions about how these trends affect your portfolio, you can reach out directly to Eric Peterson. He's the designated broker at Activate Real Estate. His number is 509-903-9077. So let's just get right into the data.
Yeah, it's great to be here. This quarter's report is it's fascinating because it contradicts almost everything we assume about commercial real estate right now.
It really does.
So let's frame the discussion with a rapid-fire summary. Just consider this your quarter in a minute.
Let's hear it.
First off, tenant demand is fiercely outpacing supply, which has driven the vacancy rate down 1.7% over the past year.
Which is a huge drop.
It is. Second, the local construction pipeline has essentially evaporated, just dropping to a mere fraction of historical averages.
Right.
Third, despite that incredibly tight supply, rent growth is surprisingly sluggish. It's actually sitting below the national average.
That's the part that really surprised me.
Yeah, me too. And finally, sales volume is surging. I mean, the 2026 year-to-date transaction numbers are already crushing the totals we saw in both 2024 and 2025.
Wow.
So if you remember one thing from this deep dive, it's this. CDA office space is historically tight, but the underlying pricing dynamics suggest a market that's, well, kind of holding its breath.
Okay, let's unpack this because we have to start with that 4.0% vacancy rate. I mean, in today's economic environment, a 4% vacancy for office space is almost unheard of.
Exactly. It's incredibly rare.
Right. Over the past year, the market absorbed 110,000 square feet of space. But the net delivered space, the new inventory that actually came online.
It's only 2,400 square feet.
Yeah, only 2,400 square feet.
This sounds like an intense game of musical chairs, but the host isn't bringing out any new chairs when the music stops.
That is exactly what's happening. And to fully grasp how tight the market is for you as a potential tenant or owner, we need to clarify what absorption actually means.
Okay, just break that down for us.
That 110,000 square feet of absorption doesn't just mean people were touring buildings. It means leases were signed, keys were handed over, and physical space was taken completely off the market.
Right, it's spoken for.
Exactly. So when you consume 110,000 square feet, but only build 2,400 square feet.
The existing space just gets aggressively cannibalized.
Precise. But I want to push back on what that actually signals. With only 6,200 square feet currently under construction, especially when you compare that to the historical average of 30,000 square feet.
Which is a massive drop.
Right. So are we absolutely sure we're seeing booming demand, or is this dropping vacancy just like an illusion caused by a paralyzed construction pipeline? I mean, if developers completely stop building, vacancy drops by default as the few remaining spaces get snatched up.
That is the core tension of the entire region right now. It's, a mix of both. But you are right that the paralyzed supply pipeline acts as this massive magnifying glass on the vacancy rate.
Right.
To understand why developers have stopped building, you have to look at the mechanics of commercial development today. Elevated interest rates, soaring replacement costs for materials, and just incredibly cautious lending environments mean that developers simply cannot pencil out a new office project.
The math just doesn't work.
Exactly. Unless they have a massive credit-grade tenant pre-leasing the entire building at top-of-the-market rents, the banks won't fund it. So the pipeline drops to just 6,200 square feet.
That's tiny.
For context, 6,200 square feet is basically one small boutique professional building in a market containing roughly 6.3 million square feet of total inventory.
That is effectively zero new supply.
Zero.
So what does a frozen pipeline look like on the ground? Like, if I'm a local business owner looking to expand, it sounds like my options are practically non-existent.
They really are.
Yeah.
The market has an availability rate of just 4.7%.
Wow.
Yeah, that leaves roughly 300,000 square feet of total available space scattered across the entire CDA office market. If you're a growing tech firm or, say, a medical practice in Coeur d'Alene looking to expand from 5,000 to 10,000 square feet, you can't just move across the street to a new build.
Because there aren't any.
Right. You might be forced to split your operations across multiple smaller disjointed locations, or you might just have to halt your expansion plans entirely.
That's tough.
It is. But on the flip side, if you're a landlord, this dynamic provides tremendous security. Your tenants literally have nowhere to go, so your retention rates remain incredibly high.
Okay, but here's where it gets really interesting to me. If tenants are trapped and landlords hold all the cards, shouldn't those landlords be charging a fortune?
You would definitely assume so.
Right, because logically, extreme scarcity should trigger skyrocketing rents. But that isn't what the report shows at all. Year-over-year rent growth in the CDA office market is a mere 0.7%, with overall market asking rents sitting around $24.12 per square foot.
Which feels like a massive paradox.
Totally. If the market is a game of musical chairs with no chairs left, why isn't the person holding the last chair demanding a premium?
It absolutely looks like a paradox on the surface. I mean, 0.7% rent growth is incredibly slayish. You compare that to the national average of 1.5%.
Which is already pretty low.
Right, and it seems even stranger when you compare it to CDA's own 5-year average annual rent growth, which was a very robust 3.9%.
So what's driving this?
What's fascinating here is that the mechanism driving this stagnation really comes down to landlord psychology and risk aversion. Landlords are actively choosing to prioritize stable, predictable occupancy over pushing the envelope on rents.
So they're essentially playing defense. They're swallowing the costs of inflation because they're terrified of a vacancy in an uncertain national economy.
Exactly. Let's look at how NOI, or net operating income, actually functions for an office building.
Right, the NOI.
NOI is the lifeblood of property valuation. To protect it, a landlord desperately needs uninterrupted cash flow.
Makes sense.
So if a landlord gets aggressive, and pushes a tenant's rent up by 5% or 6%,
The tenant might push back.
right, and if that tenant decides they simply can't afford it and vacates to go remote, the landlord is in a terrible position. They lose months of rental income while the suite sits empty.
Plus the costs of getting a new tenant in.
Exactly. They had to pay hefty leasing commissions to a broker to find a new tenant. And they will almost certainly have to offer massive tenant improvement allowances, like to tear down walls and replace carpets to customize the space for the next business.
Oh, wow. I didn't think about the renovation cost.
They're huge.
Yeah.
When you run the actual math on those turnover costs, it is often far more profitable to renew your existing tenant at a flat rate or with a very marginal 0.7% increase. Landlords are intentionally trading high yields for absolute stability.
Okay, that makes the sort of 0.7% number make a lot more sense. It's not a lack of demand at all. It's a calculated defense mechanism.
Exactly.
But looking at the geographic breakdown in the report, it seems like that flat average is hiding some major local turbulence. The entire CDA area is not behaving the exact same way.
You're spot on. Geography is doing a lot of the heavy lifting behind that 0.7% average because the market is deeply fractured right now.
What do you mean?
Well, when you look at the Coeur d'Alene Central Business District, or CBD, you have a razor-thin vacancy rate of 1.2%. The downtown core is effectively entirely full.
1.2%.
Wow. Post Falls is also performing very well, sitting at a tight 3.4% vacancy. But then the data pivots sharply.
Okay.
The Hayden and Dalton Garden submarket is struggling with a 6.8% vacancy rate.
Ouch.
And it has a massive negative net absorption of negative 39,577 square feet.
Wait, negative 39,000 square feet. That means tenants aren't just pausing, they're actively packing up and leaving that specific area. Why is Hayden bleeding tenants while the downtown CBD is packed to the brim?
It's a great question.
Is this like a case where businesses are prioritizing highly desirable locations just to lure their employees back into the office?
That is exactly the leading hypothesis. It's a behavioral shift we call a flight to quality.
Yeah.
During times of economic hesitation or, when companies are navigating the remote work hybrid model, the physical office has to offer something compelling.
Right, it has to be worth the commute.
Exactly. The Coeur d'Alene CBD offers walkability, coffee shops, restaurants, and the lake. It justifies the commute. Hayden and Dalton Gardens, generally speaking, contain slightly older, more suburban inventory.
So it's harder to get people excited to go there.
Exactly. Without those premium downtown amenities, it's much harder to attract and retain staff.
So to bring back our earlier analogy, if the whole market is a game of musical chairs, Hayden might be the broken chair that nobody wants to sit in until the music completely stops.
That's a perfect way to put it.
And that nearly 40,000 square feet of negative absorption in Hayden acts as an anchor, pulling the entire region's rent growth averages down and just completely masking just how tight the CBD truly is.
Precisely. And the primary forward signal you should be watching as we move into Q3 is how this submarket standoff resolves.
What should we be looking for?
As the CBD remains functionally full with 1.2% vacancy, will that pressure valve eventually burst? At some point, growing businesses that want to be downtown simply won't fit.
And they'll have to look elsewhere.
Right. They will be forced to look at those vacant spaces in Hayden as a cheaper alternative.
So if tenants are trapped geographically and landlords are playing it incredibly safe with rents, how are investors reacting to this standoff? Are people actually buying commercial real estate in this climate? Because 2024 was basically a ghost town for transactions.
Oh, it was completely dead.
Okay.
But they are definitely buying now. In fact, the sales data is where we see the market's pulse really accelerating. The trailing 12-month sales volume for the CDA office market sits at $16.8 million.
Okay, and how does that compare historically?
To give you some context on that, the 5-year average is $12.7 million, and the 10-year average is $11.0 million. So we are significantly outperforming the historical baselines.
Wow.
But the real story is the momentum shift we're seeing right now in 2026.
The year-to-date contrast is jarring. I mean, the 2026 year-to-date volume is already at $12.1 million. When you contrast that with the entirety of 2024, which only saw a bleak $1.4 million in total volume, it's literally night and day.
It's a massive turnaround.
It seems like buyers who were just window shopping and holding their breath 2 years ago are finally writing checks.
They are entirely off the sidelines.
Yeah.
We tracked 25 completed transactions in the past 12 months. The average price per square foot across those deals was $169.
Okay.
Properties traded with a median price of $910,000, which tells us there is heavy activity in the smaller private investor space. Think local doctors or lawyers buying their own buildings, or private individuals making local investments.
That makes sense.
But the deals ranged all the way up to $9.5 million, which shows institutional capital is active here too. But honestly, the most critical data point from these 25 sales is the occupancy of the building's trading hands. The average vacancy at sale was a remarkably low 2.8%.
Wait, 2.8% vacancy at the time of sale, so they aren't looking for empty fixer-uppers to renovate?
Not at all.
They are buying practically turnkey cash registers, like buildings with a highly reliable paying roster of tenants already locked in.
Exactly. And if we connect this to the bigger picture, it brings us to the capital markets data, which explains why the math is making sense for these buyers, even with elevated interest rates.
Right, because borrowing money is still expensive.
It is. It comes down to a fascinating divergence in capitalization rates, or cap rates. As a quick refresher, a cap rate measures an investor's expected yield on a property over a year.
Right.
According to the report, the estimated market cap rate for the CDA office sector overall is 9.9%. That is significantly higher than the national average of 9.0%.
Wait, that 9.9% market estimate is confusing me. If the overall market is estimated to yield 9.9%, but the actual transaction cap rate for those 25 recent sales averaged just 6.4%.
You're wondering why the gap exists?
Yeah, it feels like these buyers are actively choosing to make less money. Why would a buyer accept a 6.4% yield when the broader market is theoretically offering nearly 10%? What am I missing here?
You aren't missing anything, actually. You are just observing the flight to quality playing out in real-time capital allocation.
Oh.
That 9.9% market estimate is an algorithmic average. It factors in every single building in the region, including the older, partially vacant properties that carry a ton of risk.
Got it.
In the CoStar building rating system, these are known as 1- and 2-star properties. Buildings that might be functionally obsolete or require heavy renovations, nobody wants to buy those right now.
So their theoretical yield has to be incredibly high to attract any interest.
Exactly. But the 6.4% actual transaction cap rate reflects reality. It proves that the only properties actually successfully changing hands are the premium 3-star or 4-star assets.
I see. So buyers are willing to pay a premium, meaning they'll accept a lower 6.4% yield because they are acquiring safety.
Yes.
They are buying that 2.8% vacancy rate. They're essentially buying a reliable dividend in a market where absolutely no new competition is being built.
Exactly. And when you look at the raw pricing, CDA still offers a massive discount opportunity compared to the rest of the country.
The local prices are that much better.
Oh, yeah. The estimated market pricing for a CDA office is $142 per square foot. If you break that down by quality, It's $143 per square foot for average 3-star assets and $141 per square foot for those older 1- and 2-star buildings.
Okay.
You compare that $142 local average to the staggering national average of $267 per square foot.
Sure.
Even with the extreme local tightness, you are buying into this Idaho market at roughly half the national price.
Wow, that makes the investment logic bulletproof. If it costs you, well over $300 a square foot in materials and labor to build a brand new office building today, but you can buy an existing fully occupied building with a reliable tenant roster for $142 to $169 a square foot. You do that deal all day long.
Yeah, exactly. That specific discount opportunity is exactly what's driving that $16.8 million in sales volume. Investors from higher-priced coastal markets can look at Coeur d'Alene and see an incredibly stable, landlord-friendly environment where they can acquire assets well below replacement cost.
So, as we look to the horizon for the rest of 2026, what is the forecast? With zero new supply and tenants fighting for space in the CBD, where is this heading in Q3 and beyond?
The forecast models suggest we are going to see a prolonged stabilization at these current tight levels. Overall market vacancy is forecast to end 2026 right where it is today at exactly 4.0%.
Okay, so no relief coming.
None. Annual rent growth is expected to inch up slightly to end the year at 0.9%, though that will still remain securely below the projected 1.3% national average.
Because of the turnover fear.
Right. The fear of turnover costs will keep landlords favoring tenant retention over aggressive rent hikes.
And what are the main watch items for you in Q3? Like, what should a local investor be keeping their eyes on?
The major forward signal remains that anemic supply pipeline. With only 6,200 square feet underway, the market has zero shock absorbers.
Zero.
Any significant new tenant demand, say a mid-sized technology company or a large regional medical group deciding to relocate their headquarters to CDA.
They'll literally have nowhere to go.
Exactly. If that happens, we will either see them forced to absorb that stagnant older space in Hayden-Dalton Gardens, or we will finally reach a breaking point where rents absolutely have to spike upward to justify new construction.
The tension there is incredible. It really does trace back to that musical chairs analogy. You have a growing regional economy, businesses that desperately want to expand their footprints, and simply no chairs left for them to sit in.
It raises an important question, and this is the thought I really want to leave you with today.
Yeah.
With construction virtually at a standstill and premium space nearly maxed out, at what point does the sheer lack of available office space transition from being a landlord's primary advantage to a fundamental cap on Coeur d'Alene's regional economic growth?
That is a profound question, and one that every investor, owner, and tenant in the market needs to be evaluating right now. Thank you for joining us on this deep dive into the Coeur d'Alene office market.
Thanks for having me.
As you analyze how these trends impact your own investments, or if you need help navigating this historic lack of supply, we highly encourage you to get a custom perspective. You can reach out directly to Eric Peterson, the designated broker at Activate Real Estate. Give him a call at 509-903-9077. Until next time, keep your eyes on the data and watch out for those missing chairs.